Hello and welcome, everybody. Happy Friday. Welcome to the end of a week, the end of September, and another Sectors Made Simple webinar. I usually would say I'm pleased to be here with you all to talk about some really great news, but right now is not a great news period for the market. September was challenging, to say the least, with the S&P 500 dropping over 9%. Some FOMC announcements indicating a new rise to the federal funds rate, and a couple of other economic indicators that we'll talk about in today's webinar. But the biggest takeaways from it is we need to see what happens next. What happens next is going to be incredibly important and will very much set the trend that we will see through the beginning of winter into 2023. So right now is a very important time for us to understand what's going on in the market and what could we expect for the market to do this October. So today, I want to review what happened in September with you all. We're going to take a look at some data to back up whatever we're talking about, and then we'll take a look at some key dates throughout October that we should be aware of, as well as some overall economic and market trends that we should expect to see develop throughout October. If you're an investor or a person that likes following the economy, this is going to be a webinar that you definitely don't want to miss. So, hope you're on board. Hope you have a drink and a snack ready, because we have a lot to go through today. So, let's head on over and take a look at the presentation that I have made for the October 2022 market forecast. Quick disclaimer, I will be talking a lot today about data, past results, and most importantly, probabilities. Probabilities are percentages that we have to try and predict what might happen in the future. As with any prediction, it is solely based in historical data, and past results can never guarantee future performance. So please take everything today as educational resources, me sharing my research that I've used to create my own opinion of where we are in the market and where the market's headed from here. I want to share those resources and those findings with you all, so please take it as that, my opinion that I want to share with you all. So the goals for today's webinar are, first off, the fact that quarter 3 is done. Quarter 3 ends today. And unfortunately, it's left us with more questions than it did answers. Quarter 2 ended us on a pretty high note. Quarter 3 has been a little bit more of a challenge. So in today's forecast, I want to review what changed and what happened back in September. We'll take a look at some major market events from the past month and how closely last month's probabilities fell to real life. Whenever we're looking at probabilities, the best thing we can do is say, all right, the future is now the past. How close was our predictions? So we're going to take a look at that today. We're going to compare September's performance to September's probabilities. And then, of course, we're going to take a look at what comes up for us in October. We're going to look at some key dates that you should be aware of throughout October, as well as some more probabilities and insights as to what sectors and the market as a whole has done in the past throughout October. So here's some background context. So first off, we're going to start by going over September. September was, let's not beat around the bush, it was bad. The first 2 weeks did show some promise. The market did rise about 3.7% in the first 10 days. But just about the remainder of the month was a straight line down. The FOMC meeting that we had in the middle of the month resulted in another 0.75% increase to the federal funds rate and a speech by Jerome Powell in which he acknowledged that this desired soft landing, this idea that we can tackle inflation without lasting or sustained damage to the US economy, is going to be very challenging. It is not something that is certain, and he acknowledged that some pain might be required to get inflation back under control. Now, that obviously sets off some warning bells for citizens and investors alike, And the market didn't like that. And the market dropped because of it. But where does that actually leave us? Where did everything shape up for the entire month? Well, let's go and take a look at it. In last month's forecast webinar, we talked about this market forecast spreadsheet, this piece of information that we have showing out of the past 60 years and 20 years what the chances of these different indices going up or down on a given day were. This is what it more or less looked like. We had the S&P 500, Dow Jones, NASDAQ, and Russell 2000. But today I'm just going to focus, again, we're looking at the history here. I'm not trying to go through and do some crazy over-the-top explanation of what's already happened. We're here to talk about what's going to possibly happen. So just a review of the S&P 500 and see how close that fell to our expectations for the month. What we see on the left is the day of the month. And then again in the middle of the page. So it was one really long table that we chopped in half and then stuck it alongside itself. So we could see it in a single slide. So we have the S&P 500 over the past 66 years and its average. Or rather, the percent of times that it went up for that month, for September, or for that day rather, in September. Then we have 20 years. Then what I've added today is I've added what happened to the S&P 500 on that day this year. And lastly, if that was a surprise or not. So if there was a positive return and the 20-year average was below 50, it'll say it was a surprise. Just like if we had a negative percent change like we see on the 6th, but it was an overall chance of being positive, that also is a surprise. So expected means, did we expect it to be below 50% and it went down? That's expected. If it went up, surprise. Same thing on the other side. If we have something that's above 50% and it went up, that's expected. Went down, surprise. So just because it says surprise doesn't mean that was a bad thing. But just because it says expected doesn't mean that's a good thing. With that said, let's take a look at what the data has to show us. What we see is, for the most part, the first half of the month was mixed. We were not very in line with what's happened in the past 20 years. We found that the first 2 weeks or so were overall positive. And much of that was a surprise to the market, where we see 3 of the days being a surprise, but only one of those days being a negative surprise. The remainder were positives, and that's not a terrible thing. However, the week of Triple Witching Week, which is meant to be a very positive week for the market, didn't turn out to be so. We saw the market drop, with the largest percent change of the week coming on the 13th of September, with a 4.35% loss in a single day. By the end of the week, we saw losses, even on the days that had the highest probability. Only 1 of 3 of those days turned out to be a positive change. Looking at the second half of the month, if we just ignored, and I'm going to pretend to cover up my screen, you can do the same on yours if you want. If we just pretended that we don't see the percent changes or the probabilities, and all we look at is the expected, unexpected, it looks pretty good, doesn't it? We have 10 days in that period, and 9 of those days were expected. Only 1 of those days was a surprise. But the vast majority of those days were losses. Now, this makes us have to ask, were these expected, right here, were these expected because it was going to go down, or were they expected because they just got lucky? We see that the vast majority of the second half of September was negative. Did we just get lucky that the predictions were also negative? It's hard to say. It's actually impossible to say. But this does bring up something interesting. And let's go look at the summary of this, because I can point with my magic hands inside of this little box, or I can move my camera around all we want, but that's not going to get us to the point. So let's talk about the point. The first half of the month was a surprise to investors. And these surprises, once again, we compared to the 20-year averages. We saw that 54.5% of days came as a surprise to investors. But the average surprise loss, the average of these surprises was a loss of 1%. After the meeting, we did see 9 out of 10 days being expected. But again, that expected does not mean positive, because 7 of those 9 expected, 7 out of the 10 total days, correctly predicted losses. Whether it got lucky that the market was in a basically straight line down during that period or not, we can look at a little bit close. Again, it's very hard to say. That's the thing about probabilities, is it's an overall trend of 20 years. It's not perfect. And sometimes it's going to get lucky. To see just how different September of 2022 was for the market, instead of showing you probabilities, which are just percent of likelihood, let's go and look at some percent of price. What I've done now, again, this was based on a chart that we showed in last month's market forecast, and we'll see this again for this forecast. But what I did was I looked at the S&P 500 over the past 10 years and 5 years and tried to say, okay, what is the probability that that sector goes up or down? And not just that, what's the average return? Because that's the one thing that we don't get with those other tables. We don't get return. We just get probability. This is return. And here we see just how different September of 2022 was compared to previous months. We only saw in the past 5 years, only 2 different ETFs had likelihoods of being positives above 50%. Energy and utilities. Energy got hit 9.2%. Utilities got hit 11.5%, and they were not alone. Almost every single sector in the S&P 500 took massive losses of over 8%. Almost 8% or more. The only one that didn't was healthcare. And that's not really due to healthcare being a strong sector. It benefited from 2 things. One, it's defensive. Defensive sectors have been doing the best and technically still are doing the best. But the bigger one is that there was a recent release of trial data for Alzheimer's medications by Biogen. That caused a 40% jump in the value of healthcare, of the value of that company, and in turn boosted the share prices of other companies that are in the process of Alzheimer's medication trials. So it's hard to say whether this protection from losses was due to it being a defensive sector or to it just being in the right place at the right time. Whatever way you shake it, if we look today at the current matrix, we do see healthcare is the leader in both long-term strength, represented by positive trend, short-term strength represented by X count, and total count being the combination of the two. So now we know the market predicted losses and losses we got, but nothing predicted how big those losses were going to be. The losses were significant. So now we have to ask, why? What led us to this? Why did the market react so poorly to these announcements? Or rather, to what happened throughout the month? If I have to draw all of the information that I've tried to find together into a single sentence, this is what I've got for you. Right now, the market is looking for good news. Investors want something to grab onto for positivity, for some inclination that the market is beginning that bull market. Again, you can't look and just say, oh, well, we have to wait for the recession because bull markets start in a recession. Yes, bull markets start in a recession, but not every bull market starts in a recession. So the market wants something, and it's not waiting for the worst news to realize, oh, okay, it can't get any worse. But it also wants something good to kind of lean into and have something to say, oh, well, it's not good, but it could be worse. Let's take a look at what we got throughout September. September's FOMC meeting gave investors, well, no added confidence. What we did get was another increase to the federal funds rate, which, as of writing this, which is September 30th, mortgage rates in the US for 30-year fixed rate loans are now over 7%. Beyond that, we got the summary of economic projections from the FOMC and the Federal Reserve heads. There weren't signs of panic. There weren't massive red flags in there. But there wasn't anything good either. There was those, it's not great, but it could be worse kinds of things. But that's not enough to build investor confidence. That's not enough to prove a long-term trend of recovery, which is ultimately what the market wants. So that's where we were prior to today. Now, yesterday was rough in the market as well, but Wednesday was a very good day. After hitting essentially the June low that the S&P 500 had set, we kind of tickled that support line and then bounced off of it upward, partially due to the market feeling like that resistance barrier is there for a reason. Or sorry, that support barrier is there for a reason. Maybe this is where things turn around. Well, for one reason or another, yesterday we dropped below that line again, and today we crashed through it. Now, if I had to point to a single thing of why, this would be it. There are two different ways to calculate inflation. If you want the rundown of the two different ways, check out last Friday's webinar. I go into a lot of detail about it. All I'll say for today, there's two types of inflation. CPI inflation, that's what humans and us look at. Then CPE inflation, not what we look at. That's what the Federal Reserve looks at. So this CPE inflation went up. PCE inflation, not CPE inflation. My apologies. This PCE inflation went up, seeing a 0.2% increase, which excludes food and energy. Now, what that's telling us is that all of the movement that the Fed has made up to this point hasn't topped inflation and started to see it recover. We're still seeing inflation at an extremely high level. And food costs, remember, this CPE inflation excludes food and energy, this 0.2%. Food costs increased price as well, up 0.8% compared to last month. The only single thing that was a reassurance for this inflation announcement was the fact that energy costs dropped by 5.5%. Now, this is an economic indicator. The stock market is companies and securities. We have to ask, is the stock market alone in how it's responding to all of this craziness? No, it's not. And that's not a good thing either. This damage that we're seeing done to prices and to investments is not limited to stocks and carries over into the bond market as well. Federal bond rates continue to shift towards what's called an inverted yield curve. And to quickly explain what that is, typically, whenever you tie up your money in an investment, you want some return. The longer you have your money tied up in that security or that investment, the more return you want. You're not getting your money for a longer period, so you want it to give you higher return to match the fact that you can't invest it in something else. The US Treasury releases a number of different bonds and what are called notes. Two that we're about to take a look at are the 10-year and the 2-year. In a normal market, you would expect for the 2-year rates to be lower than the 10-year rates. But that's not the case right now. Right now, we're finding that those 2-year notes are providing higher returns than the 10-year notes. That is not a good sign, and that is the largest that difference has been since August of 2000. Let me quickly show you what that chart looks like. I will also post that link in the chat right now, and I will put it in the resources section of the video as Fred. So if you're looking for it, check out Fred in the comments. Here's what that chart actually looks like. Let's zoom into just the past couple of years here. No, that's too far. We want here and we want there. All right. What we're looking at here is the 10-year maturity rate versus the 2-year. When it's positive, that means that the 10-year rate is higher than the 2-year. When it's negative, that means that the 2-year is higher than the 10-year. That yield curve is inverted. Right now, it's inverted. And we're seeing that right now it's about 0.4% lower than the 10-year. Or rather, the 2-year rates are about 0.4% higher than the 10-year. Now, again, this doesn't matter to you if you're not investing in bonds, but this matters to us when we're trying to look at where are things headed from here? Are things improving? Are we moving away from those big storm clouds? Let's look at what history has to show us. The last time we saw a number this low was not before the crash of 2008. The last time we saw a number this low was in the middle of 2000, right before the dot-com bubble and the 2000 to 2002 recession. So what this tells us is that right now there's a lot of uncertainty in where we're headed from here. But what history has shown, when the rates get this low, recessions have usually followed. There has not been a period in the past 50 years where we have had an inverted yield curve this low and escaped without a recession. The Fed wants to change that. Obviously, just because it's happened in the past doesn't mean it won't happen in the future. But the cards are stacked against them, and they've got a big task ahead of them. Corporate bond rates are not any different. We're seeing investment grade and junk grade bonds as well, increasing in risk. We're finding that there is a lot more distress within the corporate bond index, the CMDI, and that has not been going down and is now approaching levels that, again, we have not seen outside of a pre-recessionary period. So that's part of the reason why the market has performed so negatively in September. We wanted good news. We needed any good news. We didn't really get it. And where things are at moving into October is rough. So now we've covered September. Let's talk about October. Back in September, we had a number of key dates that we got to follow. We had the FOMC meeting, we had the end of quarter 3 rebalancing, and we also had the triple witching week or quadruple witching week. October is not as filled with big dates that the market waits to see what happens and then reacts accordingly to. So what we do have, though, is still a couple of big events that are going on that the market will likely have a response to. The first one is October 13th. The BEA will publish the CPI inflation data. This, again, is the version of inflation that you and me probably think of. And when a news source says inflation rises to 9%, this is the number they're talking about. It's not PCE, it's CPI. The second thing that we get from the BEA is going to be what they call the advance estimate for quarter 3 GDP numbers. Why it's called advance, we'll talk about in a minute. But what that means is it's our first look at quarter 3 GDP numbers. And then towards the end of October, there's not a certain this starts this date, but it will be the start of earnings season for companies that are within the stock market. So we'll be getting results for how these companies fared throughout quarter 3 and seeing a little bit more about, have companies been profitable? How are they weathering this economic situation? This puts their books where their mouths are and will be very interesting for us to follow. But again, I'm getting into the details already. Let's actually go through and take a look at some of the bigger points for each one of these 3 events and why they made it onto this list. For CPI, the Fed, again, prefers to look at PCE inflation. Hello, Maria. The Fed prefers to look at PCE inflation for a number of reasons. Again, if you want a full rundown of that, check out last Friday's webinar. I go through core versus headline PCE and CPI. But again, most people like you and me, we're probably looking at headline PCI. If you don't follow all of these publications very closely and you just read MSNBC or whatever news source you probably read, or you might read rather, you're probably going to see the CPI inflation numbers, the headline CPI inflation. We'll get that. That's what we will be getting on October 13th. Now, the most recent, why do I keep putting CPE? It's PCE or CPI. So many 3-letter things. We did see an uptick in inflation for the last releases of data that we got. So this September CPI release is going to be very important because we thought things were getting better and then we got August's numbers and they weren't. So now, as we're starting to get September's numbers, we need to see where things go. Because now there's not really a trend. So will there be a trend? Will we see that inflation number continue to go back up, indicating that what the Fed's been doing isn't working short term and that things aren't getting better for consumers? Or are we going to see that last month was a blip and that we are well on our way towards a lower inflation number in the future? No matter what way it goes, whether it goes the way of the consumers in the market with a lower inflation rate, or it goes the way of kind of the bears, really, and inflation continues to rise, the market's going to be betting on it. The market will respond accordingly to which way those inflation rates go, regardless of what way it goes. So this definitely makes it onto our list of things to pay attention to. Now, not all is bleak. Again, we've seen now one market, energy, that's begun to drop down in terms of inflation. But there's another one as well that I didn't talk about but do want to mention. Housing prices. Housing prices, for the first time in a very long time, have begun to drop. Partially due to the rise in the federal funds rate, but again, that's the Fed fund rate doing its job. We've seen major cities, housing costs in major cities finally start to tip out in July, dropping back down now as demand cools down, but also money becomes a little bit more expensive to borrow. So again, that is what's coming our way on October 13th. Let's now take a look at what we have to expect on October 27th with the advance estimate of quarter 3 GDP. This is going to be huge. This is the one that I'm most interested to see. In the summary of economic projections that we received from the Fed and from the FOMC, they expected a positive year-end change for GDP. They expected it to be somewhere in the range of 0.2 to 0.4%. But that's positive. That's positive GDP. We're not positive right now. We're far from it. In quarter 1 of 2022, we saw GDP drop by 1.6%. Quarter 2, 0.6%. We've got a lot of ground to cover before we can get back to saying we stagnated in 2022 as opposed to we fell backwards. Now, it's very important for us to know this. These two numbers that I'm talking about, negative 1.6 and negative 0.6, are the third publication made by the BEA. We get the advance, which is the very first one. Then we get the second, and then the third estimate. We will not get the third estimate for quarter 3 GDP numbers until December. But I don't know about you. It's not December yet. We're a far way away from it. And by the time we get December's numbers, quarter 4 is almost already done with. So for right now, this is going to be what we're going to get. And also, we will get this before the bulk of companies have their earnings calls. This will set the tone for these earnings. And it's very important for us to know where things end for quarter 3 GDP. As of the last time I checked, which was last Thursday, blue chips, so major institutions and the Federal Reserve itself, still believe that we will turn a positive GDP for quarter 3. We'll get more information about that in the end of October. And once again, the market will respond in a small way, likely respond in a small way to these earnings. But the bigger one that we're going to get is we're going to get the backdrop for where we're at moving into quarter 3 earnings season. No CPI for October, right? We will not get October's number for a very long time. Today, we got August's numbers, not September's. So CPI releases extremely late. Let's see. CPI, September 22 CPI release date. September is going to be October 13th. So that's going to be this one. For PCE, it's going to be, where's the next publication for the PCE? I think that's the one that you were referring to. October 28th is going to be the next PCE publication. But again, that one's a little overshadowed by the fact that we're also going to be getting October's GDP estimates on the 27th. I expect that that's probably going to be the biggest one. If we look at last month's market forecast, it didn't include the PCE release date. That is not something that consumers follow. That is something that the Fed follows because it's a slightly less volatile indicator and isn't just targeted towards urban consumers. The ones that we're going to care about and the ones you're going to see on the news, that's going to be the CPI. And that's the one that we are getting on October 13th. So now, I mentioned before that this advanced estimate of quarter 3 GDP is going to set the tone for earnings. But why is earnings the big ticket item for what's coming next? And October is only going to see the very, very tip of it. November is where things are going to heat up for earnings, and a lot of our market forecast for that month is going to be focused on earnings. Now, I will share this with you all right now, and again, it will be in the description if you're watching this recorded. There's the earnings calendar. You can go week by week and see how many companies are releasing earnings for a given week, but also what companies are releasing earnings for a given week. Now, let's go through what I have to talk about here. A couple weeks ago for members, about a month ago for non-members, we talked about quarter 2 2022 earnings. And we talked about how those earnings were different. Not because of the earnings values themselves, all right? We saw actually slightly under average performance in terms of how many companies beat or got beaten by earnings or revenue. But what was remarkable was not did they beat earnings or not. It was how the market responded to these earnings performances. The market heavily rewarded companies that beat earnings estimates and revenue estimates, where we saw an over 100% increase compared to the normal response to positive earnings. Typically, the market penalizes companies that do not meet estimates and only slightly bumps companies that did meet estimates. And if we think about that, that makes sense. Much of a company's price is not based on its earnings. That's why we have a price to earnings ratio. A lot of the value of a company is in what investors feel it could be worth. It's that speculative value. Now, current prices for stocks are meant to include those earnings estimates. Estimates are, again, our best forecast for what we expect it to be. And the market doesn't wait until we get the real earnings to say, oh, okay, now we can bump up the value. Much of the price is based on these estimates. So when the estimates are right, it's not as much of a reaction as when the estimates are wrong and we're overvalued. If estimates hit on target, or if estimates are, or rather if earnings beat estimates, yes, there will be people that are going to want to buy in. Good earnings is good. But we know that positive news doesn't spread nearly as well or as fast or as hot as bad news. When earnings estimates fall short, or rather earnings fall short of estimates, that's when we see the bigger changes, and why we see, on average, companies serve to lose more by missing earnings estimates than they do when they beat earnings estimates. Except for last quarter. Last quarter, the market heavily rewarded earnings that beat estimates. And for those that didn't beat estimates, funny enough, the change was about zero. On average, a company that missed earnings and revenue estimates saw nearly 0% change in their stock price because the market was so pessimistic. They were so negative going into that earnings season that anything that wasn't horrible news was good news. To put some number to this sort of how happy were investors leading into earnings, we can turn to the AAII and look at their bullish sentiment indicator. This is a percent of investors that are bullish or bearish about the market at a given point. July's market atmosphere was significantly warmer than it is right now. On July 21st, we saw a bullish sentiment of 30%, and that number peaked at 33.33% in mid-August. Today's is 20%. Now, again, I'm not saying that to mean this is all bad, that we're so far below that we can't expect something like quarter two to happen again. But wait, we're still a month out from earnings. There's a lot of time between now and then. And July of 2022, before this big bump in investor confidence, July started at 19.4%, lower than we're at right now. This means that, again, things aren't doomed yet. There is room for positivity, but we need something to give us that positivity. For all intents and purposes, we're looking here at a market that is not very pleased. The market wants something good. And what happens in October with bullish sentiment will likely set the tone for earnings. Because we saw last time how investor confidence played a lot into earnings. People were overall very negative. So when things turned out to be not as bad as they expected it to be, the market rewarded that. Whether that will happen in quarter three or not, I cannot tell you. No one can tell you. But I promise you, I will be here to help you unpack the information as we get it. I definitely love going through earnings reports and summaries, but also our newsletters. If you have a free Sectors Made Simple account, you should hopefully receive our newsletters every Monday. And in those newsletters are what to watch for as we enter earnings season will become key companies that are releasing earnings in that week. So you can follow companies that are important to you to see those earnings. If you don't want to hear it from us and you want to see the information yourself, that Zach's earning calendar is the calendar that I prefer to use when following earnings season. Now, it's funny. We've talked for 45 minutes and haven't gotten to talk about the probabilities for October of 2022. And again, that's partially for a good reason. Probabilities are just that. They're based on 20 years or 66 years worth of data. But every year is different. every year has its own challenges. And as we saw with 2020, not every year is a normal year. There are crazy circumstances that change how the market behaves every year. Just like when we looked at September's, we can't answer for certain if the reason that things were so expected in the second half of the month is because September is always bad, or was it that the FOMC meeting compounded investor fear? That's an impossible question to answer. But it's something. So I want to give you everything that I can, and this something is part of that everything. So let's go and take a look at those daily probabilities for these different indices to see periods of expected behavior. And to do that, we get to open up Google Sheets. Here is what the data looks like. Let me zoom out a little bit. All right, let's go. F11 is full screen. Can I hide this? I can. Hooray! All right, it all fits in one screen. I apologize if this is small on the screen you're watching this on. Don't worry, I'm about to summarize the big points of it in a minute here. Let's go week by week. The first week, what we're going to see is a mixed bag. One thing is for certain, the NASDAQ is the one that will perform the best out of the three, but again, that's all relative. The majority of days are, well, some good, some bad. Week 2, we see things cool down a little bit for the S&P 500 and for the Dow, and heat up for the NASDAQ, with every single day in the past 20 years above that 50% average line. Week 3, we see things pick up for the S&P and cool down a little bit for the NASDAQ, but not very much. The NASDAQ still is performing well above average. Then ending the month, Tuesday the 25th is historically the roughest day of that week, and surrounding it are days of mostly positive performance. Now, for those that either didn't or couldn't see that screen very clearly or want a little bit more detail on it, let's summarize that in a spreadsheet or in our slideshow here. Out of the Dow, NASDAQ, and S&P 500, if we only looked at the last 20 years, what we can do is take an average. We can say what is the average probability for any given day. That is quite literally just find the average percent. If we do that, we find that the NASDAQ has positive returns with an average of 54.6%. Compare that to SPY, which is slightly below at 54%, the Dow at 52.6%, and the Russell 2000, those small cap companies, coming in at the bottom with 51.4%. But that is higher than September. September had an average of 44.4% across the entire market. So seeing every percent above 50%, that's some reassurance. That is a positive sign. So October seems like it's going to shape up to be better than September. But there are no clear weeks of strengths or weaknesses. Every week has its ups and downs. But with that said, let's go take a look at sectors and see how sectors have done. We go over here to sector probabilities. Now this one I can make a lot bigger. How about that? If we look here, we have two columns. One that is the last 4 years and one that is the last 10 years. I don't think you need me to tell you that XLU, utilities, stands out as the clear sector that has historically performed the best, with not only the highest percent positivity, the only sector to have a over 50% positivity rate in the past 4 years, but with a sizable percent return as well, of almost 3% over the past 4 years and hitting that 3% line for the past 10 years. But look a little bit closer. Look beyond the 4 years and look at the 10 years. We see that only 2 sectors fall below that 40% line. Compare that to, well, these are the 5 years, but the 10 years didn't shape up to be much different. What we see here is that the majority of sectors over the past 10 years have historically trended positive, with only one sector, energy, being under that positive return line, below a 0% return. So every other sector, and SPY itself, over the past 10 years, has trended positive in October. So what does that tell us? That utilities stands out as the clear leader. But over the past 10 years, we find that the majority of sectors performed extremely well in October, with an average probability of positive return across all sectors of 59%. Compare that to 44% from September. That is a 15% swing over 1 month for the expectation of things being above its starting point, of a positive return. Now, the Stock Traders Almanac has a lot of great information. And one of the things that they provide is a list of different sectors and industries that begin bullish trends, when those trends begin and end. I'm not going to provide the full list out of respect to their data, but what I will say is that October is the beginning of the majority of those bullish trends. There are bullish trends for sectors such as defensive sectors, such as staples and healthcare, but also cyclical sectors, such as discretionary. So we're not going to just see only defensive sectors or only sensitive sectors or only the middle guys performing well in October. There should be strong performances across the market. And to kind of back that up, there is one other piece of information that I would love to take from the Almanac and provide. October has been the beginning of bullish periods for a number of sectors, like we just discussed, but it's also served as the turning point for 12 post-World War II bear markets, with the most recent being 2011. What that means is that October has been the enemy of the bears. It's been where we see a market bottom occur and recovery begin. In my opinion, this is again now back to my opinion and out of the world of data. October is huge. September was big because we got a lot of information. October is big because we're not getting as much information, but we'll learn a lot more about direction. I said in our Matrix Monday that this week, the one that we're in right now, will test the market. And it has. But October as a whole month will test the market even further. We'll get new inflation data. We'll get the beginnings of Q3 data and the beginnings of earnings season for Q3. How the market prepares and responds to these events is going to be massive. Not just for where we are in October, but where we're headed from here. Again, October historically has been a positive month for the market and has broken 12 bear markets since World War II's end. Now, on one hand, economic indicators will very much be, we shouldn't hope for good news there. We kind of have to be realistic and realize that a lot of these indicators move us closer and closer and closer to that recession period. Now, before you start thinking about that and panicking, remember that bear markets end in recessions. Bull markets begin in recessions, but not every bull market needs a recession to begin. But again, The FOMC still believes there is some hope for a soft landing. But personally, I'm not focused on that because what's going to play out there is well outside of my control. What's within my control is how I look at the market and how I look for areas of opportunity within it. And strictly from a stock market standpoint, October offers a lot of opportunities for growth across different sectors, and a lot of that could be due to the fact that historically, the end of September has been rough. October has been that recovery. So now we're at the end of September, moving into October. We have seen this drop that either history has shown or reality has proven. But now we have to ask the question, where is the bottom? Are we seeing the bottom right now? Are we going to see October once again become, for a 13th time, a breaker of this bearish trend in the market? That part I can't answer for you. All I know is that October, not so much just in information, but in price performance as well. That is still information in a regard. Where the market goes from here, where these different economic indicators land, and where we are moving into earnings season for quarter 3 will be extremely important. Not for predicting the short-term direction of the economy or the stock market, but predicting a more long-term trend for where we begin the fall, moving into the winter, and hopefully the path towards recovery. Hello, Jonathan. Do you have a video on how to create your own matrix on Spreadsheet? I'm interested in the research. Thank you. I do, but it's extremely old. Let me see if I can find that for you.
Yeah, I'm looking for it.
Yeah, that would be a very, very old one. Techware, if you go to the Learn site, there is a course there called Introduction to the Matrix. It's one of the videos within there. Kike, Jonathan, can we get a spreadsheet like the one that you showed us today? Unfortunately, I can't share this one. However, I will work on one for the next market forecast that I would be able to share with you guys. Yeah, so unfortunately, I can't share the ones that I showed today. But for the next market forecast, I will make one that I can actually share with you all. But that's what I have for you all.
I found the actual webinar, I think.
Kira found the webinar, so she will put it in the chat right now if you're interested for that. But again, that's what I have for you all today, to review where things are wrapping up for September and where things might be headed for October. Again, I'm trying to predict things or trying to study things a month out, and things will change between now and then. But rest assured, I will be here when major events occur to help demystify the world of economics with you all and try and help you to understand all of this information and how we can use it to better our investing strategies simpler. So thank you all so much for joining us today. If you have any questions or topics that you want to see us cover in a future webinar, please shoot us an email at support@sectorsmadesimple.com. We'd love to hear from you. But until next Friday, thank you all so much for joining us today, and we hope to see you all very, very soon. Take care.